My name is Sylvia. I've been working with Gregor and 27pilots for the past 4.5 years to help promote the venture client model. I am guessing that most of you know who Gregor Gimmy is and what 27pilots is, but just in case, Gregor, would you introduce yourself and 27pilots?
Yeah, thanks, Sylvia. Good morning to everyone. Thanks for joining. I'm Gregor Gimmy. I founded 27pilots in 2018 out of BMW. 27pilots is a company that helps venture client units or helps corporate set up venture client units and helps corporate venture client units to grow and become, better. And yeah, so much about myself, more main thing during the conversation.
So today's webinar is called Buy.Invest, Will Venture Clients Save CVC? And that first part of the title is actually a reference to your book, Gregor. What's that book about and why did you decide to write it?
Well, the book is primarily about questioning the status quo of corporate venturing and the way corporate venturing has been lived and defined over the last 20 years by, big academic institutions from a Harvard to a Berkeley to a Stanford, but also by, leading management consultants and corporates. So that's the main intention. What the book does is not question the why of corporate venturing, but how it was executed, really the methodology and the tools behind corporate venturing. And the book proposes a new way of thinking. Many books about corporate venturing or articles or papers are more about how do we improve corporate venturing? How do we improve the current way of doing corporate venturing? And the book is saying, no, we need something new, correct? We don't, it's not like making the horse faster. It's, we need to create a car, correct? We need something totally different in order to achieve the mission of corporate venturing better. And so proposing that new way of thinking and also the rationale behind the book as well, this new thinking was not born in academia or in a vacuum or in a brainstorm or research of myself. It was born out of my work at BMW. So really in a corporate setting, I was trying to make corporate venturing better so BMW could benefit better from startups. So the fact that it was born in a corporate setting and from here on it was adopted by multiple corporations across the world, and it's now also being taught at multiple business schools across the world. This I thought was, really my base motivation to put this all into writing in a book.
And so was BMW the first venture client or trying to tease something? Has there been very famous venture clients before you started with that term at BMW?
Well, that's a very important question. So definitely venture client, the term is new, but the activity that describes venture client is not new. So there have been venture clients by definition since the existence of startups. There was no venture client model, there was no venture client unit, but we'll talk about that later. And actually, one of the main inspirations while I was working at BMW around 2014, so about 10 years ago, was my time in Silicon Valley. And in Silicon Valley, I learned about the relevance of clients or the venture clients for the startup ecosystem. But most importantly, I learned about the relevance of, startups for, corporates there. And I saw that the corporations that were most able to engage with the best startups that this was really a key critical success factor.
Right. And one of those very famous people, we actually prepared basically a quote from that person.
Right. So how and why did Apple get into desktop publishing, which would become the Mac's killer app?
I don't know if you know this, but we got the first Canon laser printer engine shipped in the United States at Apple. And we had it hooked up to a Lisa actually imaging pages before anybody, before HP, long before HP, long before Adobe. But I heard a few times people would tell me, hey, there's these guys over in this garage, left Xerox Park, you ought to go see them. And I finally went and saw them, and I saw what they were doing, and it was better than what we were doing. And they were going to be a hardware company. They wanted to make printers and the whole thing. And so I talked them into being a software company. And we, within 2 or 3 weeks, we had canceled our internal project. A bunch of people wanted to kill me over this, but we did it. And I had cut a deal with Adobe to use their software.
Right.
Yeah, those are 50 seconds of really, really important messages for everybody listening. And I think for really the whole corporate venturing world. And at the end of the day, it states, even if I'm Apple and even if I'm Steve Jobs, there are small companies out there that are better at what we are doing. And what we need to do is we need to cancel what we're doing internally, or maybe just use whatever the startup is doing in order to improve and to be faster and more competitive in our corporate setting. And the emphasis here is really about using the startup technology, becoming the client, the venture client.
Right.
So before we dive further into it, I'll just want to give everyone a quick update on what we're doing. Welcome to everyone who's joined. So before we get to the juicy question, will venture clients save CVC, which might be a bit provocative for a couple of people, we first want to establish a common base of understanding of what corporate venturing is and of what the venture client model is. So first, we're going to talk a little bit about the definitions. We're going to clarify what's what. And then the main part will be to discuss really the future of corporate venturing, where is this going, and how is the venture client model going to change this direction. As you can see, we have enough time for Q&A at the end. If you have any questions throughout the webinar, please use the chat. We're going to address all of your questions. And yeah, just this webinar is for you. So if you have questions, ask them. That's the best way, I think, to learn. And to start with the definitions, so we've heard CVC, we've heard venture client a lot already. Gregor, let's start with the basics. What is corporate venturing? What's the goal and why do corporates want to venture?
Well, when we think about corporate venturing, the main thing we need to keep in mind is the goal behind those two words. Because many times what we do mistakenly is to think about the activity of corporate venturing, not the goal of corporate venturing. So the goal of corporate venturing, and that's how it emerged, is to gain competitive advantage from startup innovations. That's it. And that's an official definition that you can find across anywhere, whether it's the Harvard Business School, whether it's the Corporate Finance Institute. This is the object. Now, today, obviously, there is, an expansion of corporate venturing. We're talking about corporate venturing, you building your own startup as a corporate, so the inside out. So this is a new flavor of corporate venturing, but the original corporate venturing goal and school is about corporates seeing that startups have interesting cutting-edge technologies that can make a difference if I integrate and use this technology into my competitive position. Now, why, and that's also important, why is corporate venturing relevant? startups have been over the last 30, 40 years the source of the most relevant technology innovations, whether it's PCs, whether it's semiconductors, whether it's, enterprise software, whether it's pharma, biotech, anywhere you look, any sector you look at, and when you look at what are the main things that have been invented over the last decades, you will see that most of that comes out of a company that was born in the startup ecosystem. So to be able to engage with our startup ecosystem, to draw benefits out of and synergies with that ecosystem, that's really the main goal of corporate venturing. Now the activity, and that's the white sentence underneath the green one, is, it's in the past, corporate venturing has been synonymous with minority investments. Right? It's important. It's not just it's a specific type of investment. It's a VC investment. So in the world of academia, corporate venture capital equals corporate venturing, and investment. When they talk about investment in startups in corporate venturing, it's all about a VC type investment, which means you own a non-controlling minority equity stake. You have no special rights. You have really no strategic influence over the startup in this type of investment model. So that would be, the basics around corporate venturing.
Right. And then, so you mentioned already in 2014 at BMW, you coined this new term, venture client. Now, what is that and how is it different to this corporate venture capital term?
Okay. Well, the fundamental thought, back then was really the goal to obtain a strategic benefit. Now, you can only obtain a strategic benefit from a startup technology if you're using, correct, the technology of the startup. I mean, you cannot benefit from a bicycle by buying an equity share in the bicycle company. You can only benefit from the bicycle if you ride the bicycle, right? So my thinking back then was really it's all about being the user of a startup, and that's when we talk about venture client.
Right. And so this is what it means to be a venture client, but then why does it need a model particularly? Because if you say it's basically of using it or purchasing the startup product, could be just part of purchasing, right?
Yeah, that's what corporates intended actually before starting to invest. And what then the corporate saw is that this didn't work. First of all, it didn't work because it was hard for purchasing to find a startup in the first place. But secondly, the purchasing processes were designed for purchasing technologies from established companies. And just like you're using a different model to invest in a startup in comparison to investing in a publicly traded company, this is where, a new model for investment was born in the 70s called venture capital. The same logic you need to apply when trying to transfer and use startup technologies. That's why taking as a base the generic technology transfer, technology adoption processes, but making them specific and changing them specifically to fit the needs of a startup, this is what really made the difference. And here's where we see is that if you apply the generic processes that a corporate has to buy and adopt technologies, it would take you about 2 to 5 years to bring in startup technology. You would have a hard time finding the right startup. You knew the quality of the startup will be low. There's little ability to measure the impact. But if you have a good model and a dedicated specialized model around venture clienting, this is where we start seeing that venture clienting really makes a huge difference in benefiting from startups. And the model that I designed back then at BMW, which has been refined over the last 6 years now with 27 pilots, we've applied this model at multiple corporates, over 20 or 30 corporates, and all very demanding and very good corporates, in terms of their ability to execute whatever they do, correct? World leaders like BMW, Airbus, Bosch, or Siemens. So there's a glimpse into the essence of the model, where the venture client unit is the model starts with intelligence, correct? Starts with finding what are your problems, that startup solve best, and is there really an offering in the startup ecosystem that can meet those benefits? Then it's around piloting, correct? You need to validate this, but the pilot is not just a demo session. It's not a pitch session of 5 minutes or 10 minutes. It's an in-depth validation of the startup technology in a real use case by the real end user, and not in a lab in some faraway startup ecosystem. It's bringing the technology into your home R&D department or into your factories or wherever the technology needs to prove itself that it can make a difference. And then the whole element around startup adoption. Now you want to be a non-exclusive client. You just establish some kind of supplier relationship. You want to be an exclusive client. You want to be the only one using this technology. Here's where you go around and do an acquisition, a majority investment in order to have the exclusive rights over a startup technology. And so if that's a driving engine of the model, the intelligence, pilot, and adoption, what the model also needs to have, and this also is different, and this is also something that you cannot do out of normal purchasing, is you have to have a separate strategy and a structure. You have to have a team, a specialized team that has a special training. You want to place this in the right part of the organizational chart. You may want to have venture client units across the globe if you're a global corporate. You also need to work on the culture, but not on the culture of becoming a startup, but of the culture of embracing and understanding startups, so that you generate a pull for startup technologies. And you also need to set up technology and data, special software to run a venture client process, to monitor it, and to measure its impact. So all those 4 elements are really relevant core elements of a good venture client model.
This sounds quite complex, actually, and not really like something that one person can do by himself or herself. And so I think this is also why back in 2015, after you established the model at BMW, you've also founded a unit around this new approach, a venture client unit, back then, the BMW Startup Garage. Can you walk us through the thought process and what kind of function such a unit has within a corporate, and why exactly such a unit is necessary?
Okay. Well, first and foremost, when I started in BMW in 2012, my initial job description had nothing to do with startups. So nobody came to me and said, set up a venture client unit or help us be better with startups. I set up my job. My mandate was to set up a new innovation team that did a long-term innovation strategy at BMW. And And as I was doing this and coming from Silicon Valley, with having lived there for many years and worked in the startup ecosystem, while I was doing this initial job, I saw a gap at BMW, what I call the startup gap, meaning there are many, many thousands of startup technologies that if we would bring them into BMW, whether it's the BMW product, a car, vehicles, or whether it's a process in IT or manufacturing, logistics, we could gain competitive advantages from using those novel technologies faster than our competition. And here's where I saw that, the traditional way of corporate venturing couldn't really meet these expectations because it was not scalable, correct? A corporate venturing based upon investment, you're limited to 3 to 5 startups per year, costs you millions per startups, correct? This is nothing you can scale. If you want to bring in hundreds of startups, in investment just becomes the bottleneck rather than the facilitator of accessing startup technology, correct? This is then how this idea of venture clienting came about, where I said, no need to invest, purchase directly, but do it in a different process. And part of that model and the thinking, part of the structural element that I just showed was, well, if I have a team that does nothing but this, we will just be better. If we have a team that does nothing but venture clienting, we would just be better. It's kind of like saying, if you do 10 sports, you may be more or less good at those 10 sports, but if you really want to be excellent at one of those sports, then you rather do just that sport and nothing else, right? Same here with the venture client unit. And basic thought was not only to have really more time that we could dedicate to the topic of bringing in great startup technologies, it was also, being specialized and making sure that this department would follow a process and would have also a decision system that is clearly shaped towards the need of accessing great startups. And the third element and the thought about creating a unit is to create trust and to foster communication both inside BMW, also outside BMW, to communicate to the world and to the BMW colleagues that this is corporate venturing done differently, that this is corporate venturing that specifically targets the need of my colleagues at BMW, which was to use startup technology to solve critical problems. And it was also important to establish a unit with a brand and a name, correct, known as the BMW Startup Garage, to communicate to the venture ecosystem, to startups and VCs alike, that this is about becoming, the paying client, the user, the market for startups, and by that having the ability to attract better entrepreneurs to BMW.
I want to add one thought to this. So looking at that slide, you mentioned there's thousands of top startups a corporate can benefit from. But if you look at conventional CVC investment strategies, they're usually targeting startups with technologies, innovations very close to the core business, because it doesn't really make sense for a construction company to invest in a software that would digitalize HR processes, something like that. So, but still, these technologies corporates can benefit from these technologies, but through that investment approach, there's no way that these startups would even be on the radar, right? I mean, so if we look at the CVC approach, from these thousands of startups, there's maybe hundreds who are actually interesting. So corporates are missing out. On top of that, it's, as you mentioned, quite capital intense. And I like that there's already an overview of a couple of corporates that you, through 27pilots, have worked with, have helped establish venture client units. And looking at all these, but there's many more who have started to adopt the venture client model. Since you left BMW and brought it to other industries, have you seen any limitations to this model in terms of particular industries or organization specifics, if it's a decentralized versus a centralized corporate? Is there any place where the venture client model doesn't work?
Mm-hmm. Well, one of my, let's say, one of the weaknesses I saw in the corporate venturing model that's driven by investment was the very fact that this is something for very, very rich companies. And because you needed a lot of capital, and there is no financial asset that's riskier than a startup, a share. And that's why it's called venture capital, correct? And venture capitalists, we all know, even the best venture capitalists, they put money into 10 startups and 5 of those go bankrupt, right? So it's a huge risk. And this is really only large multinationals that have, huge amounts of, cash, that have a very strong balance sheet. They can afford to put aside, the 50, 100 or 500 million to be able to play in the investment world, because investing in the good startups is a very selective approach. Not even Sequoia is allowed to invest in every startup. Now the big global brands, obviously they have, access to good startups, but not every startup. Our analysis has shown that even large global brands are only allowed and invited to invest in 3 out of 10 startups they want to invest. So this limitation of not having money, of not having a strong enough global brand to be invited into, private equity deals with startups, this is something that venture client model does not have. Even if you are a small and unknown company like we back then, correct, 27pilots, we, with just a handful of employees, we started using startup technology right away. So we practiced venture clienting, obviously ourselves on the very first day. So yes, venture client, the model, the approach of starting and using startup technology works for a company of any size. The important question here is if startups exist that have relevant technology for you. So if your company is in a market, or its strategic challenges are not supported, or there's no venture capital flowing into any of your strategic goals or strategic processes, then venture client makes no sense, and because basically startups make no sense for you. But I'm struggling to find a company or a sector where startup technology does not play a role. And this is really a change over the last 10, 20 years, is where there is so much more venture capital flowing into so many more startups that the scope of technologies that startups are offering is really, there's really startup technology for every part of the value chain, from the core R&D product to the HR, marketing, sales, IT departments, correct? So this is why venture client model really works for every size, and to my conviction also in every industry.
All right. I mean, sounds like venture client makes a lot of sense. Let me ask the obvious question. Since corporate venture capital is very risky, has huge capital investment attached to it, why did corporates start with it in the first place?
Well, Yeah, that's I got this question actually also many years ago from a colleague on BMW in 2015, and so now if corporate venture clienting is so good, why is not every company doing it? And well, this I think what happens with many innovations. You know, they appear, and sometimes you think, why did we do this before, right? But there's really a reason why corporate venture capital was born, and the reason really is that, and I describe this in detail in my book, is that back in the 70s and in the 80s, in the 90s even, and the early 2000s, there was no easy way of finding startups. So the startup databases were, you know, hidden in the black boxes of a venture capital, a PC or hard drive. The venture capitalists, they had the lists, they had the deal flow, they knew which are the entrepreneurs, which are the technologies they invested in, and this information was not accessible publicly. Private VCs went to corporates and said, give me money for my fund, and then I will allow you access to my deal flow. They still do this today, and this is and this just still normal practice. What has changed today, though, is that you can find all deal flows in publicly available private equity databases like a PitchBook or CB Insight and many others, correct? So the fact that today there are databases where you can access startups no longer is, that basically means that you no longer need a CVC unit or a unit that positions itself as an investor in order to actually learn about the fact which startups exist and which don't.
All right. And now coming back to the question, the title, Will Venture Clients Save CVC? Why does CVC need saving? Or why do you think CVC needs saving? Or is there actually evidence that CVC needs saving?
Yeah. Well, the fact is that CVC was born out of the reason to have access to startups, right? Because there was no public databases. So you set up a CVC because that was a way for you to find more startups, calling you and asking for your money, correct? But the condition for your CVC unit to exist was to not lose money. So the intent was strategic. I want to gain access to startup technologies, but given that you put so many millions into your CVC operation and capital, the condition basically from the CFO side was you're not allowed to lose money, which is kind of a strange thing in the corporate venturing investment world, correct? But anyway, so the fact is now today, obviously, those CVC funds, they're measured continuously. What is the net asset value of the startups in my portfolio? And as soon as the net asset value goes down, this is when the executive board goes and says, maybe we need to stop. Because now we're starting to lose many millions because the value of the shares, basically because it's shareholder money, correct? It's not management money, it's shareholders' money that they're putting into startups, high risk. So the dependency on the valuation of startups, really the dependency on the volatility of this part of the financial system, this is what makes, this is what really, putting CVC into a crisis modus every time, the private equity markets are having problems. And as we're seeing since 2022, 23, the valuations of startups have gone down. So have, the value of the assets in corporate funds. And that's when the boards start pulling the plug.
And whoops, one more. And this is actually what's happening right now. There's been recently a couple of articles about exactly that fact, that CVC units are being closed down. Here are just a couple of examples for that. And there's also a drop in active CVC funds. There's been a drop overall in the capital market, but it's quite obvious to see that there's a decrease going on. And looking at that, is there any scenario, in your opinion, where it does make sense for a corporate to invest in a startup?
Definitely using capital as a tool to access startup technologies is a must do. It's really, really relevant. But the investment model is a controlling investment. It's not a non-controlling investment. So what you see here in this chart, you know, over 50% drop in active CVC funds. Basically, CVC funds stopped investing or were closed down 50% from one year to the next. This happens because of the change in valuation of a startup, not because the quality of the startup technology has dropped by 50%. So now this is obviously also a great indication of great opportunity for corporates to do a controlling investment to acquire startups. So I do not see a scenario where a non-controlling investment in a startup makes sense if the objective is to gain a strategic benefit. And there may be corporates who are just doing investment in startups for financial benefits, right? There are more and more corporate VCs who write on their website, we are just like Sequoia, correct? And then we're just looking for the financial benefit. And this may be as it is, but if your objective is strategic, now there are other corporates who say, well, there are some startups where we can be the first investor or where the startups needs capital. And this really then helps the startup grow. And I would argue here that if a startup doesn't get money from a private investor, you as a corporate should not touch that startup. Because then, you know, if the private VC market is not interested in the startup, it's probably not a good one. And what makes you better in making that decision than thousands of VCs who have probably, you know, more dedicated, more expert and expertise around, you know, picking around the right startups. There may be one small scenario for the very big corporates that they can invest in startups after a venture client activity with a startup. So after they have seen that, wow, this technology works. And if this corporate now from here on, you know, they have, you know, lots of capital and they can opportunistically invest in the startup in order to benefit from the growth that also results from being a venture client, as long as this investment doesn't kill the strategic benefit, correct? They're always got to be careful that being a shareholder of a startup may kill the startup by the very fact that other corporates no longer want to work with that startup, right? Because they are afraid that the startup may disappear, being acquired by the competition. Here, in those rare cases, an investment after venture client activity may make sense.
And with that in mind, and looking at also some of the examples we've seen on corporates who are using the venture client model already, we do see a trend that companies are using both approaches, that they set up a venture client unit, they have a venture client process in place, but they also have a CVC arm. And there's a couple of different types of organizational structures there. Some are under the same management, some are completely different and completely different separate units. What's your take on this, basically going with two lanes? How do you see this type of corporate venturing strategy, setting on both horses, but basically, and if so, then what would be your advice? Better under one umbrella or better separate?
But what we're seeing is that if a company has no venturing unit, they definitely do not set up both. correct? They don't go for venture client and venture capital. What we are seeing is that they start with venture client because it just leads to more startups, better startups, zero capital risk. I mean, you can't beat that value proposition. Now, after doing this for many years, venture clienting, and they see the opportunity to then invest once they see that a startup has been validated, this is a trend that we see with a few really big companies. Now, another type of companies that already has a corporate venturing that's investment driven, we're seeing some of those adding venture clienting, but we're also seeing that the investment activities becomes more and more just really financially driven, right? So the really the leading, let's say the biggest number of startups, the biggest impact comes from the venture client activity, and the venture client now becomes the strategic resource for the investment team, so to speak, in order to reduce investment cost and risk, correct? So having both really is, I would rather say, the future is, being a good venture client with the option to invest, rather than what's happening today is that you are a corporate investor attempting to become also a venture client. So you do the investment first, and afterwards you try to adopt a startup solution. And this is what we see is failing. It's costing a lot of money, primarily because obviously the investment team doesn't have the tools and the processes and the mindset to think and act as a user, because at the end of the day, they are investors, correct? And this is what will drive their activities and their decision making.
At this point, I want to address the audience to please feel free to use the chat if you have any questions. If you have a different opinion, maybe also let us know. So if the company you work at pursues both or one of these corporate venturing strategies, and we'll be happy to answer all your questions at the end. So now leaving CVC a bit to the side and looking at the venture client model. 2014, you coined the term. It's 10 years later. Where is the venture client model today? How established is it in Germany, Europe, and the world?
Well, we're still at the early stages, right? Innovations take their time. And an anthropologist once told me that it took humanity 30,000 years to adopt fire. So it won't take 30,000 years for humanity to adopt venture clienting. So we are looking at maybe around 50 to 100 venture client units worldwide. And there's about, 1,000 CVC units. So there's still, room to make. And we definitely see that there's no reason why there shouldn't be 20,000 venture client units, because at the end of the day, every company that has over $1 billion revenue, that would be a size that would require a dedicated department. So the amount of CVC venture client units will in the future be, 10, 20 times bigger than the amount of CVC units that we're seeing today. But we are not there yet, but I bet that within the next 5 to 10 years, the number of venture client units will dramatically increase.
And can you maybe elaborate a bit on the indicators that you see today already for the venture client model becoming more established, becoming the new standard in corporate venturing?
Well, first of all, it's really the data. It's just overwhelmingly better. It's really like, we discovered the airplanes, and before that, we went by ship to New York, or, there was, there was a fax machine back then, but today we have, email, we have Slack, correct? I mean, this is such a huge difference that just the effectiveness, the efficiency, and the fact that you do not have to assume capital risk is overwhelming, and that will by itself really drive humanity towards, the better technology, the better approach, which is venture clienting. What we're seeing in that validates this hypothesis is, first of all, the companies that are accepting or adopting venture clienting are generally world-leading companies like BMW, Airbus, Siemens, Bosch, Holcim. They're all world leaders in what they do. And so those companies are very good at, picking and implementing functional units or business processes that make sense. There's no venture client unit that has closed at those corporates. Not during Corona, not after Corona, and certainly not during the current, let's say, private equity crunch that's happening in the startup ecosystem. If any, they're thriving. If any, they're corporates who are just switching from one model to the next. What we're also seeing, and that's also an important trend, is that academia is more and more active in researching and teaching venture clienting. So at BMW, one of my first activity in 2014, when I started the venture client unit, was to find a master student to write his thesis. So this person, his name is Daniel, he's in China today, still working for BMW. So he was the first master thesis around venture clienting. And today there are, hardly hundreds. There are also PhD theses are starting to emerge. The other day I got an email from a professor who said, I would like to dedicate my career to researching venture clienting. So this is definitely a very important trend, because academia is also able of distinguishing whether venture clienting is just a new bottle and the same wine, or whether it's really a better wine. And that seems to be the case.
Yeah.
And the last one, maybe also important, is there's a job market emerging for venture client. Right? We see more and more, if you in LinkedIn type in venture client, you would see job positions, job categories associated with this activity, which I think is also a sign that venture client is here to stay and to grow.
I want to add two things regarding academia. Yes, fun fact, I'm one of these PhD students actually, starting to research and write about it. And the second note that I have is that you said, okay, innovations do take time. That's true. Adopting a completely new approach takes time. And yet, if we think about who are pioneers, who are early adopters, we wouldn't consider usually public institutions. We wouldn't usually consider governments to be at the forefront. And as I know, that is the case actually with the venture client model. There are public institutions who are adopting it. Can you maybe add a couple of words to that?
Yeah, this is also a very important point, because many governments are seeking an answer to how can I replicate Silicon Valley? Not because they like Silicon Valley of the climate and because it's very beautiful, but because they see that, very, very important companies with very high quality jobs are emerging out of Silicon Valley again and again, semiconductors, PCs, biotech and so on. So governments, when they look into venture clienting, they are actually supporting what makes Silicon Valley successful, which is corporates who know how to use and adopt startup technologies. And so by supporting the growth of venture clienting and the adoption of venture clienting is really also supporting the growth of the local startup ecosystem. On top of that added benefit, it also helps the public administration to become more efficient, as they will be using startup technologies faster. And this is also, obviously a strong objective of governments to provide better, more effective, efficient services to the citizens.
Absolutely. I think everyone who's ever waited in line in a polling institution can agree on that. We do have 2 questions in the chat. The first one from Miro, who wants to know the transition from a successful pilot to implementing and scaling a startup solution within a corporate setting appears to be one of the most significant hurdles in venture clienting. Do you have any recommendations on how to tackle this challenge? I'm going to pull up the process.
Yep. Well, it's one of the most significant hurdles in adopting so any new technology faces strong challenges in getting adopted, right? So it's not so much the hurdle of venture clienting, because what we say is venture client is needed if startups have relevant technology. So now you need to obviously fine tune your model to make this adoption part work. And one of the most critical elements, and what we are seeing at companies that implement venture clienting, but without a good and solid process and model behind this, is that they, at the end of the day, lack the ability to define and select the right problems. So think of this example. If you are a car company and there's a startup who has a technology that allows to charge the battery in 3 minutes to 1,000-kilometer range at a cost of 50 euros, how difficult do you think will the adoption be? Right? Nobody will say, oh, I'm not adopting this battery because, who needs a 10-minute battery charges in 10 minutes? So, but being able to identify and then also calculate what is the benefit by solving this problem, even before you go into the startup ecosystem, to do this work well at the beginning and to question the internal colleagues. Why do you want to adopt the startup? Tell me, what's your urgency behind that? Why are you not doing this yourself, correct? If you do ask those questions at the beginning, during the discovery startup intelligence phase, then the adoption will be significantly higher. And we are seeing adoption rates north of 50% at the venture client units we are setting up.
I want to add on that is that I think key is, first of all, to have a very clear process that weeds out topics that are not relevant, also startups that are not the right fit. Oftentimes it happens that someone comes and says like, oh, I have found this great startup, let's do a pilot with them. But like, are they really the best in the market? Are they the best fit? And the other thing is, and that's where we come to the unit again, it's if you have an infrastructure in place within the company to adopt startup technologies, it's a lot easier. So yes, probably in the beginning, you'll have to do a lot more convincing, you have to do a lot more talking, but the more it is established, the strategic need for startups and how the venture client process works, the easier it will get. So I don't know, Miro, if you're just starting out with venture clienting, because then I can imagine that this is a bigger hurdle. It does get easier, the better connected, the better established your venture client unit is within the company. So feel free to reach out to us. And Hugo has a question coming from a founders and a corporate perspective. He sometimes has a feeling that young founders fear corporate venture clienting because they're expecting more loss of freedom regarding their ideas. How would you comment on that? And where could this image problem come from?
Well, the image comes from, really that startups have a lot of bad experience with, let's say, bad venture clients. Right? So you're starting a company because of your clients, right? First of all, you're not starting a company for yourself. You have a product that solves a problem at your client's company, and they want to give you money for it, which is revenue, which is growth for your startup. Now, in the past, So a good venture client, you always have to make sure that what you're dealing with is a good venture client unit, because obviously as a client, you can be, pretty nasty to startups. And the model that we implement with corporates is to say, in order to be a good venture client doesn't mean you're good to the startup. It means you're good to yourself. But if you want to be good to yourself, you need to make sure that the startup is good, because you won't make the startup any better. So if the conditions you propose to the startup, like strangling them into a strange contract, like demanding IP, like some sort of strange exclusivity requests, some veto rights. I mean, you can obviously, as a client, you can put anything into a contract. Now you need to make sure that the model they're running is a good one. And we think as the number of venture client units increase, we will also see a ranking of corporates who are good at that, and those would be the ones that startups will contact first and will prefer over other clients.
And to add on that, Hugo, so there's actually a very funny example from BMW with the gaming startup Air Console. They started out traditionally in the gaming industry. They were meant to revolutionize, their idea was to revolutionize the living room and where you would play games. And BMW reached out to them about if their solution would also be possible to implement that within the car as well, which is not something that they had in mind at all. At the beginning, they were like, no, latency issues, and oh no, it's not going to work, and the market is way too small. We want to reach the gaming market, but they did go with that, and now they have there's a huge success story. You can look it up. They were the first, together with BMW, to really pioneer in-car gaming. And so actually, when you look at what Gregor said, that if you're a good corporate venture client, if you don't expect exclusivity, actually having such an established, experienced corporate giving you insights on what the market wants, there's nothing better for a founder than getting that direct feedback and getting that inspiration on how to make your solution better so that people actually want to buy it. I hope this answers it. I don't know where the image problem comes from, probably because there's just a huge cultural difference between to find. We'll help you fight for a better image as well. Yeah, all right. If there are no more questions, I do want to address the title of the webinar one last time. And in that case, I want to address the first part, buy, don't invest. I hope we've answered the question if Venture Client will save CVC. We're optimistic it will. Hope you are too. And in terms of that first part, Gregor's book, we did promise that we're going to raffle 3 of Gregor's books among all participants. I think we went with a bit of a different route. Gregor, if you want to explain.
Yeah, there is this startup, or that former startup called Amazon, who revolutionized the world in '95 with a lot of interesting, things. And one of the things is that you can, as you publish your book there, you can, also have a promotional activities where people can, order the book for free. So for a limited number of days. So we will share the link to the book. You can order it for free till Friday. I'd be looking forward if many of you order this book and also share it with anybody you think who can benefit from this book. And if you leave an honest review, that would also be great, as this will then help make the second edition of this book better.
Perfect. All right, so I hope all of you are already on Amazon downloading your free ebook version. In case there are still any questions, please feel free to reach out to us. We are happy to answer also follow-up questions. Also, once you've read the book, if something comes up, reach out to us via the LinkedIn messaging service or here via email. And thank you so much for joining. Thank you for your questions and your interest in the Venture Client model. Have a lovely day and hopefully see you soon.
Thank you very much.